Interest rates move to multi-decade highs. Affordability, let's face it, it's flat out terrible. And there's really no meaningful amount of supply that's coming in the market. In fact, higher rates are locking more and more people from wanting to list their homes because they have such low rates. I covered in a few videos that 39 or 38.7% of people have their homes paid off. 80% of people have rates below 5%. So these higher rates are even creating less inventory, which is not great news in most markets across the nation that's really, really in need of a big injection of supply. Hey everyone, it's Rayce Robinson, your favorite Florida mortgage broker, and I want to look at some data. All of it's not positive, but I always try to look at what's the silver lining, what's the opportunity, and it doesn't really make, data is not positive or negative, it's data. And one of the things I made the decision when I started covering the market many years ago was look at the data for what it is, both for a real estate investor, as an owner of a mortgage company, and somebody that works with a lot of buyers and real estate agents in the market, and look at where the puck is going, as Wayne Gretzky would say, go where the puck is going, not where it's been, and have that help shape what I'm trying to do to be successful as a mortgage person, real estate investor, and someone in the market. Now, when you look at 30-year fixed rates here at 7.37%, remember, this is Mortgage News Dailies. Everyone's rate is actually different. But this is pretty good for high credit score borrowers are now in the mid to low sevens. And personally, this is multi-decade highs. I have not worked, and I've been in the mortgage industry since the early 2000s. I have not seen rates this high since I've been involved, especially with where affordability is at. So definitely this has been a drag on the market. Now we're close to 4 million transactions a couple times. We've been right on that. And I really think with the numbers come out for August, which will come out in September, we could break through that 4 million annualized number of transactions, which means that we're 40+% off the highs, just meaning higher rates with prices not really going down is getting less and less buyers that want to come in the market. And when they want to come in, they're having a hard time, especially first-time home buyers as rates move up to qualify for mortgage payments. When you look at this article here, multi-decade highs are changing the way mortgage rates are quoted. And this is another thing to note, is that as lenders, one of the things that we have done with a lot of buyers is knowing that there's a good chance, look at MBA, Fannie Mae, Freddie Mac, all predicting, and this is the good news, transactions to increase a little bit next year or rates to go down. And so if rates fall, you don't want to pay a lot of cost on your loan if you're doing a mortgage now. Well, what we do to offset costs, especially somebody with lower credit, is we increase the rate to get a higher yield. And this article here gets in the weeds. I'm not going to cover it, but it points out something that I've been noticing, which is banks understand that people are going to probably be refinancing if rates fall. And so when we give a client an option at a higher rate, we're not getting higher yields because lenders don't want those loans at the higher rates, because typically as a bank you would think, oh, we want higher rates. But the challenge is the higher the rate, the more likely someone is to refinance. So banks are not rewarding buyers that are willing to take higher rates, and that's going to require buyers to typically pay more money up front, more discount points and origination fees. And if we can't raise the rate to offset that, it just becomes one more barrier to entry, because for a lot of people, the cash to close is a big part. And now when you're adding points and discount fees, it makes it harder to save up for a down payment. Another thing that we need to be paying attention to in Florida specifically, and this is an article from Fortune magazine, which saying a looming insurance shock spells trouble for housing markets in Florida and California. And they talk a lot about how insurance companies are pulling out. And if you look at this chart, I thought this was really interesting. They're showing the amount of markets that have 50 to 60% increases since March of 2020 to April 2023. And look in Florida, really all of Florida, really one almost the brightest purples on the map as far as, overall states that have just had a lot of appreciation over the last few years. You put in a lot of the natural disasters and hurricanes and increasing housing prices. It just makes it harder for insurance companies to want to insure. And one of the things that we need to be careful, both as real estate agent, mortgage people, and investors, and even buyers buying in the market, is we are really always up front when we're pre-approving someone, try to pin the tail on the donkey, so to speak, as far as what's the maximum price they can be looking at. And as rates are increasing, that's going down. And then we are sometimes getting insurance quotes coming in $1,500 to $2,000 a year higher than what will be normal for a particular house. And if you think about every $10,000 in price is equivalent to about $60 a month, that means that extra $1,500 could equate to $20,000 in purchase price, plus rates have went up a little. Now this buyer that was just pre-approved maybe is buying a house $30,000 or $40,000 under what they would have bought. So you really got to pay attention when someone's putting in an offer, when you see homes with older roofs and different things like that. You want to make sure you're working together with your lender, getting insurance quotes up front, and making sure these buyers that are right on the edge, and let me tell you, a lot of them are with rates higher, those insurance can knock them right out of the deal. And especially in Florida, we're also dealing with condos. I've done condos, forever. They're more flexible as far as FHA and Fannie Mae and Freddie Mac. Everyone's doing them, but the banks are getting super strict on the HOA fees, and we need to be aware of that because not just so much HOA fees, but on the association, they are dotting every I, crossing every T. I have more and more realtors call me saying we had a condo deal fall apart because the lender had an issue with the association. Now, honestly, there's not a ton you can do about that. You can actually make sure the lender's ordering those condo docs up front. Sometimes it takes a couple weeks for them to come in, and you never know exactly what's going to come up sometimes when I review those documents because every lender's different. Unfortunately, some underwriters are tougher than others. Some lenders are tougher than others. So you really just got to start that process, as soon as you can. And then last thing, I did want to cover Hometown People. I was on the phone last week with someone from Hometown People about a loan that we had with them. And she let it slip or told me that she felt based on the numbers that she was looking at, they would run out of money next week. So maybe we want to lock in those buyers right away because if they run out of money and the buyer's not locked in, they don't have access to all those funds. So I'll just leave with this because, I talk to a lot of real estate agents, do a lot of presentations, and someone asked me, what is the silver lining in all this? Affordability is not great, not a lot of inventory. We're going to a slower time of the year for most markets, and I think it's going to be a slow couple months. What I would say the good side of that is one, regardless of what the date is, there's going to be real estate agents and mortgage people having record months. I see it again and again. So data is just data. Two, you need a plan that you're executing on consistently. If you don't have a daily success plan, if you're not making phone calls, doing social media, doing texting, working on things that you're casting a wide net and not spending a ton of money on marketing, things like Zillow and the things that have worked in the past, you got to be able to execute because more realtors are going to be getting out of the business. More lenders are going to be getting out of the business. And I would say the positive is that, all markets are cyclical. They typically have a 5, 6, or 7 year normal cycle, 1 or 2 year of a boom cycle, and 1 or 2 year of a bust cycle. And when you look at the way transactions are falling, we've definitely been on that, wrong side of the equation as far as this being in the industry. I think that will change. I think that will most likely change first quarter, second quarter. I can't really call for sure next year where you're going to see things really picking up, at least as far as the data goes. Don't use that as an excuse to not do well. We've had a pretty good year. I know some realtors have had record years, and I think there's lots of opportunity for people to have a plan and execute on it consistently. Don't forget about my classes on Tuesday. They're the biggest online gathering of real estate agents in the United States. We cover some really good information. I send the invites out every Saturday. If you have any questions on that or anything else, reach out to me. I'd love to help. As more information becomes available that moves the market, as always, I'm going to cover it here. Have a great day, great week. I'll talk to you soon.